That's what the headlines want to do. They want to make you fearful because they want you to click. It's clickbait. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Where's all the distressed properties? Welcome back to Pillars of Wealth Creation. And on this Hump Day Hustle, we're going to talk about distress. And we have heard over and over that we're going to see a ton of distress. Office, multifamily, maybe even dipping into some industrial, self-storage, and so on. And the headlines, man, they wreak havoc. The headlines show that we have a ton of distress that's coming at the tipping point. We're here. We're past it, by the way, because it was supposed to already have been happening, and it's just going to continue to bulldoze us. We're going to see prices drop. We're going to see massive foreclosures, all this kind of stuff. But where is it? Why is it not here? What are we waiting for? That's the question. And I think I just saw an article the other day because we're going to see these banks collapsing. We've got so much in loans coming due and in real estate loans coming due, and so much distress that's going to happen because interest rates have been propped up. They haven't come down, and people aren't going to be able to refinance. And now an article came out and said, well, not so much. The banks look like they're just fine. The average LTV is like 60%. And it looks like people are going to be just fine. They're going to be able to refinance. They're not going to be able to cash flow as well as they, once hoped or once were, cash flowing, right? You're going to have a debt service of 1.3 to 1.5 versus 1.8 to 2, right? So that is all of a sudden looking like, well, maybe the banks are going to be okay. We're not going to see this big crash of banks that a lot of people were expecting. A lot of people were expecting that commercial real estate was going to bring down a lot of banks and going to bring massive trouble. I actually listened to a podcast probably about a month and a half, 2 months ago, and that was the storyline was these banks. Now, could it still happen? Sure, it could still happen. I don't want to. Nothing I'm saying here today is not necessarily not going to happen. So that's, we still don't know. Real estate, here's one thing I do know. Real estate's a very slow moving asset class. It doesn't move like the stock market. It doesn't move with emotions. It still does, but it's slow. And simply is, look, we've been negotiating on this property that we think we're going to end up buying. We've been negotiating this property for months. I mean, many months, like 6 months. We've been working. We came to a verbal agreement, an LOI, probably a month ago now, and have been working on getting a purchase and sale agreement signed here. And that's been many weeks. And we still don't have one signed. And when it does get signed, if it does get signed, it could be 90 days before we close, 75 to 90 days before we close. So we're looking at, by the time we're all said and done here, if we do get this property closed, we're looking at 9+ months of being like operating on this property. And that's how slow real estate moves. And that's not a unique situation, by the way. There's plenty of deals. If they're on market, fully marketed deals, a little bit different. But if they're off market, it takes a long time. So real estate is very slow moving. So all this stuff could happen. We've got a ton of loans coming due, right? We've got, $1 trillion worth of loans here coming due between now and 2025. A lot of those loans are floating rate bridge loans, and in the ones that aren't are still, need to be reset at today's rates. And so if today's rates are elevated, which they're very elevated. They went up, quite frankly, because of the debate. And now it's more likely that Trump will be in office. And because Trump's a big spender, and, loves to give money to corporations and juice the economy, there's fear that inflation will tick back up. And so interest rates, or the, the rates are going up. And so we'll see what happens there. We keep on being promised that the Fed is going to drop the Fed fund rate, but that keeps on getting delayed, right? The can keeps getting kicked down the road. And I don't know, what's their incentive? Why would they in 2024? A lot of people think because of election pressure. And so they'll do it, soon here before the election to help with the election. I don't know. Maybe not. But I just don't see even a 25 or 50 basis points drop by the Fed isn't going to do that much for overall mortgage rates. It's just not. And so to me, that's not going to change. And so people are going to refinance into a higher rate. And so that's the fear, is that, look, they're not going to have an option, and they're going to have to refinance, but they're not going to have an option. They can't refinance at a higher rate. The other fear is, like, look at how much building's been done. Austin and Dallas and Houston and Phoenix and so on. They're building like crazy. And so how can you keep up with that? Now there's a report that Phoenix is actually not really growing very much. I don't know about that. I haven't done that research, but I saw a headline that Phoenix has stalled out their growth, and that now they can't keep up with the demand. I don't know. There's a ton of markets out there, though, that have a ton of building happening. And so with that building, you've got slow rent growth, and with slow rent growth, of course, we aren't boosting our NOI, which is the hope that, hey, interest rates are going up, but NOI is going to continue to do really, really well. And then, we're going to be able to refi at higher rates regardless. It's not going to, certainly we would rather have 3% than 6%, but we're going to be able to do it. Right. But now rents aren't going up in a lot of markets, and expenses are going up in every market across the country. Expenses are going up drastically. Happily, in the Midwest, rents are still going up at a pretty sizable tick. Right, we're seeing in all of our markets between, that like 2.5, I think, is the lowest we're seeing, and 4% or greater. I think 4.7% is our best market. So we're seeing good rent growth, but we're seeing huge expense growth. Insurance costs are through the roof. It's ridiculous. Property taxes are just atrocious, and it's criminal in my opinion. But that doesn't help with refinances. So there's this theory that people can't refinance, and you're going to see this flood of buildings. But I'm not so sure. I don't believe the headlines. Here's the thing: is doom and gloom sells. I mean, it just is. Go listen to Fox News, CNN. Please don't listen to Fox News or CNN, or really even your local news. I hope you don't spend your time listening to that. If you love being informed, that's fine. Do some quick research and then move on with your life, because they love selling doom and gloom. It just is. That's what sells, and that's what sells. That's what people get excited about. That's what people love that, and they get themselves worked up about it, and then they just continue to go and dig and then fear, and man, that's what sells. Fear sells. And so that's what the headlines want to do. They want to make you fearful because they want you to click. It's clickbait. And they want you to click, and they want you to read, and they want you to hear about all the negative things that are going on in the world. And I'm not saying that everything's positive and rosy and we're in this growth market all of a sudden, and things are going to be amazing, and we're going to see multifamily prices are going to skyrocket. No, that's not what I'm saying. But what I am trying to get at is, like, I don't think that we're going to see this big distress. We're going to see some, right? You've seen GVA, Tides Equity, and several other companies out there that have had foreclosures. Apple's Way, I think it was. They've had foreclosures. I've had a lot of their portfolio getting foreclosed on, but those are more or less one-off incidences. Now you are seeing a lot of syndicators shut off distributions, and even really well-positioned syndicators shut off distributions. But that is totally different than getting foreclosed on, and that is done for various reasons. But a lot of times, look, a lot of these syndicators, a lot of these groups, not just syndicators, there's a public equity, publicly traded company that they're not allowing for basically people to trade out of their stock, sell out of their stock. So there's a lot of that happening, and they're protecting capital, right? They're protecting in that case, a run on their stock, right? But they're protecting their investors from, a potential bad situation. And so a capital, uh, pause on distributions, all that means is, hey, look, we're not cash flowing the way we wanted to. Maybe we're not cash flowing at all, but we're not cash flowing the way we expected, and we're going to preserve some of our capital for reserves. We're going to build back reserves. We're going to make sure we have enough money for this upcoming rate cap that's happening. That type of thing. So I don't. Certainly, it's something to watch if you're invested in a deal and it's paused distributions, but not necessarily something to be overly concerned about. I mean, understand why it's done, because that can tell a big story, but it doesn't necessarily mean that you're losing your capital. I think some people freak out about that. I see a lot of concerns and posts and like, oh my gosh, I can't believe they paused distributions. And I'm going, well, I know the story behind why they did, and it makes sense. And some of it I don't. And so you certainly research it. But I think for the most part, you're going to see very small amount of distress in the market. There's certainly going to be some, right? There's certainly going to be some, but loan modifications are happening all over the place. Most lenders are working with current owners to try to make something happen, because look, if that lender has to go to foreclosure, it's just going to cost them a ton of money. They're not making money on that. And yeah, they've got the personal guarantee. It's non-recourse, but if they can go after the personal guarantee, but that's really difficult. And so the chances of them getting their money back are really slim. So why wouldn't they try to work a deal out with the current owner and try to get that thing back up and running and moving, and kick the can down the road? And by kicking the can down the road, the hope is that, well, we're going to see increased rents, expenses hopefully stabilize a bit, NOI grows, maybe interest rates go down, and in 2, 3, 4, or even longer years, then we'll get our money back, versus losing a pile of money. And as the bank, that's what the lender's looking at. Can we get our money back in a couple of years, or is foreclosure the better option? Sometimes they say, look, foreclosure is the only option because we don't see a path forward. And that's when we see those distressed sales. But I think that's going to be a one-off distress sales. I think that's going to just continue to be like that. Honestly, even when you look at the current loans, the vast majority of the loans out there are really solid loans. I'm talking fixed rate, 3%, 4%, great terms. And then you've got the bridge loans out there those are the ones that are risky. And so out of the bridge loans, let's just say 50% of the bridge loans went under. 50%. That's only going to give you, in multifamily particular, that's only going to give you like 3%, 4% of the apartments are going to get foreclosed on. That's if 50% of them get foreclosed on, right? Which is not happening. So let's be more realistic. It's 10%, 15%, 20%, right? And so when we start to do the math, we'd look at it and say, of all the multifamily out there, there's only going to be a percent or two that would potentially be in foreclosure. And that's if the lender's not willing to do a loan modification, all that kind of stuff. I think that number is even smaller than that. And so, how is that going to affect the market? I don't think it's going to affect the market much, maybe a little bit, but not much. Uh, Here's the crazy thing. So, I went and looked at a distressed property the other day, and the broker says they've got piles of tours, over 20 tours happening on this property. They're expecting to have a ton of offers, and likely this distressed property is going to sell for a price that is just unattainable for us. We'll see. We're going to certainly put our best foot forward on this property, but my guess is somebody's going to pay more, because what's happening, what I'm seeing happening in the market, I'm actually seeing a higher level of exuberance than I did in 2022 at the peak of the market. Now, you say, well, wait a second, now prices are down by 20, 25%. How are you saying that? They're down by 20, 25% because the NOI has shrunk, because rents have, in a lot of cases, flatlined or gone up less than expenses. So now expenses, we got a big expense creep. So NOI is less, and you've got way higher interest rates. So now instead of a 3% interest rate, you're getting a 6% interest rate. So that's the only reason that prices have really gone down. They haven't gone down because of opportunity. I feel like the vast majority of sales, I don't feel like it's evident by our underwriting. The vast majority of sales right now that are happening are actually less lower return profile than the deals that were happening in 2022. Now, that's okay if you're buying these deals fixed rate and long term, but again, if you're buying bridge, a ton of risk. And so if you bought in 2022 with bridge, a huge amount of risk, you lost a bunch of value. You got to do a loan modification. That's the only way you're going to move forward. If you bought in 2020 to 2022, right? 2023 and beyond, now we've seen prices go down. You might be fine with bridge, maybe, as long as prices go up. I don't see that happening either. So, all right. So a lot of rambling here, but I want to kind of get my thoughts together here and let you know. So distress that we're seeing, where's it going to happen? I think you're going to see it in some markets more than others. You're going to see it in some of those southern markets, but those will get eaten up really quickly. So most people won't even know that it happened. It will be there, but it won't be this huge presence of distress where it's actually going to negatively affect the market that much. And so you might see a tick or two lower in prices, but you're not going to see much. So that's what I think you're going to see mostly. Now, are we going to see a huge run up in prices? I don't think so. I think that over the next 5+ years, you're going to see a very stagnant market. The prices that you see today are likely going to be the prices you see tomorrow. Now, that's not necessarily true. The cap rate is probably the better thing to say. The cap rate you're seeing today is the cap rate you're going to see, in 5 years and 3 to 5 years from now. So I don't see that changing much. It's going to be difficult to push NOI. You can push NOI, but it's going to be more difficult to push NOI than it was over the past 5 years, just because I don't see this huge exuberance in rent increase happening, and I see expenses keeping up with rent more likely over the next 3 to 5 years. So there'll be deals. There'll be isolated, really good deals. I shouldn't say really good deals, but good deals. And there's I think you got to be really patient in today's market. And if you're going to be a buyer, honestly, I think you're going to have to be, or a passive investor, I think you're going to have to be okay with lower return expectations over the next couple of years. I just do. Everything I see is going for a lot of money compared to the returns that you used to be able to tick. So when we used to underwrite a deal and you could say, hey, this thing can make you a 15 to 18 IRR, that same deal, if you're willing to buy it today, you're going to have to be okay with a 10 to maybe 13, 14 IRR at best. If you're being conservative with your numbers. Now, where people are getting deals done is they're being pretty aggressive with their rents or with their cap rate exit or so on, and they're making these deals, quote unquote, pencil out. In reality, they're probably going to still get that, maybe 8 to 12% IRR versus, just a few years ago, very realistically, you could hit over 20 IRR on a deal. That's my opinion. Not a huge amount of distress, fairly stagnant market for the next 3 to 5 years, with good operators being the ones that are going to win. And, the people who are aggressive, the companies who are aggressive out there right now are not going to win. The companies that are getting poor debt are not going to win. The companies that are being patient are getting long-term debt that are thinking about kind of where the future is and operating really well, they're going to win. So be patient out there, focus on operations, and man, that's it. Make every day Saturday. Talk to you soon. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.